Hello and welcome. Today we're working on the cash flow statement using the indirect method, which is the most common for the first section, which is operating activities. So if you're new, my name is Jeff from Finally Learn, where we're teaching cash flow statement. We're in the middle of the principles of accounting sequence. We're in cash flow, so I've got articles, videos, playlists. So let's get started with this little problem. Let's assume Car Inc. purchased land for $43,000. They issued $20,000 in stock and we paid the rest in cash. Now, the $20,000 purchase of land is a non-cash operating, investing and financing activity, not operating. So there is a part of that though that is a investing because you're paying cash for land. Equipment was sold for $18,000, resulting in a $1,000 loss, and we have the following extra information. So let's think about what we are trying to do. We're trying to put things in operating activities, and we start with net income. We're on the indirect method. So we have net income plus or minus adjustments. Then we have investing activities. So we're buying or selling non-current assets. And then financing activities has to do with long-term debt and equity. All right, so I kind of cheated a little bit by putting the categories here to the left just to make it a little bit easier so the video is not quite as long. So we're going to start with on operating activities. Operating activities includes anything involved in net income plus or minus, so let's do plus or minus any current assets or current liabilities. All right, so what is our net income? Our net income is $45,000. We'll just point to that, $45,000. Now we have an increase in accounts receivable. So here's our rules. If an asset goes up, we're going to assume that cash goes down. It's as if we're buying an asset and paying for it with cash. Now, here's what we're doing. When we're taking the accrual information and moving it to a cash flow kind of format or cash flow statement, we're looking at, it's almost like we're putting on a filter, putting on glasses that have everything to do with cash. If you take out the cash piece, everything else affects cash. So what we're going to say is, if anytime an asset goes up, cash goes down. Anytime an asset goes down, cash goes up. Now, what do we do about a liability? If a liability goes up, then we're going to assume cash goes up because you're basically borrowing cash. Okay, so the increase in increase in accounts receivable. Increase in accounts receivable means cash goes down. So we're going to subtract. We're going to make a negative $12,000. Because accounts receivable goes up and cash goes down because it's an asset going up and cash going down. All right, what about a decrease? We have a decrease in inventory. So we know that's going to be a decrease in asset means cash goes up. So it's going to be the opposite sign. So just $7,000. Increase in prepaid expenses, $4,500 increase. That means cash goes down by a negative $4,500. We paid cash to make those prepaid expenses. Prepaid expense would be something like prepaid rent. We had to pay that to get that prepaid rent. We have supplies that go down, so we call it a decrease in supplies. So we make that a positive $600. Increase in accounts payable. Now we've switched. This is a liability, so a liability going up means cash goes up. It's the same sign, so increase in accounts payable means that cash goes up $14,000. Now, we have a loss on the sale of equipment. Now, we sold equipment for $18,000 and then there's an additional, $1,000 loss or whatever because originally the equipment is on our books at $19,000. Well, that $1,000 is not an expense. It functions like an expense on the income statement. We already have included it here in the $45,000 net income, so we need to take a loss that's subtracted, and to get rid of it, we need to add it back. So we're going to add the 1,000. We need to add 1,000. And then dividends received, we received 3,000, and that is cash going up, dividends received. So let's add this up, and we get 54,100 is our cash flows from operating activities. All right, so this is the section that's the more, usually the largest, and it's the more difficult of the three sections. So let's look at, we have just two activities on investing. Investing is anytime we buy or sell non-current assets. So long-term assets or non-current assets. And the way you can think about these, this would be investments, it would be plant assets, it would be intangibles. So we have two things going on here. We have a purchase of land. Okay, how much did land cost? Well, we want the cash effect of land. So we purchased land for $43,000. So you're tempted to put $43,000 there, but we're not. We're going to put 43. We issued $20,000 of stock, so we only paid how much cash for the land? Well, we paid $43,000 minus $20,000. So we only paid $23,000 for that land with cash. Remember, this is the cash flow statement. We're only looking at the cash effect. All right, so now let me ask you this. Did we receive cash of $23,000 or did we pay cash of $23,000? Well, we paid cash of $23,000. So what we want to do is make this a negative $43,000 plus $20,000. So we need to make sure that it has a negative $23,000. All right, we sold equipment. We sold equipment for $18,000. We sold equipment for $18,000 and we received a $1,000 loss. The loss doesn't matter, but we received cash of $18,000. So we're going to add $18,000. So we have purchase of land. We paid $23,000 in cash and we sold equipment for $18,000. We received cash. So what is our cash flows from investing activities? It's going to be a negative $5,000. We've invested more in land than we did receiving money from the sale of equipment. So that's a $5,000 negative we're investing in non-current assets. All right, the last section is financing activities. So financing activities relates to anytime we have long-term debt or anytime we have stockholders' equity. And shareholders' equity, whatever, I'm just going to call it equity. So we issued common stock. Now, this is not the issuing common stock up here. That's a different transaction, but we issued common stock in the amount of $12,000. Now, did we receive more cash or did we pay cash? Well, we received cash, so that's going to be a $12,000 plus increase in cash. And then we paid dividends, and we know dividends are going to reduce our cash, so we're going to make that a negative dividends paid of $11,000. So our cash flow from financing activities is going to be a $1,000 amount. So we issued $12,000 and we paid $11,000, and so we have just a positive of $1,000 from financing activities. So what is the net cash flow for this company? Well, we start with operating. We're going to add investing and add financing. So now we're at $50,100 is our positive net cash flow. If it were negative, it would be a negative number here. The cash would go down. So sometimes on a cash flow statement, it would say we started at $100,000 plus $50,000. Now we're at $150,000. Now we have one other thing to finish this up. We have a non-cash buying land by issuing stock. Sometimes they call this a non-cash investing and financing activity. Because what is it? If you buy land, that's investing, but if you issue stock, that's financing. So it's both, but it's non-cash. And that's going to be how much? Well, we issued stock for $20,000 to buy land. So that is an additional information here is $20,000. So this is how you do an indirect method for the operating activities and how to do an investing activities and financing activities, all on the statement of cash flows. Hope this is helpful for you. Thanks for watching. We'll see you in the next video.